keynote, that is the strategies to reduce AML transaction monitoring false positive. For this, I would request Mr. Sandeep Seal, Principal Consultant and SME Financial Crime Azentio, a domain expert with over 15 years of experience in anti-money laundering and financial crime. He possesses a deep understanding of the AML framework, including KYC, CDD, EDD processes, risk classification, transaction monitoring, FATCA compliance, trade-based money laundering, rules and regulatory reporting. His expertise enable clients to meet AML compliance and anti-fraud obligations effectively. He has conducted numerous presentations and training workshops on AML, false positive reduction, and AIML for banks and financial institutions across geographies. Additionally, he excels in understanding business requirements, solutioning proposal preparation, responding to RFPs and RFIs, conducting proofs to concepts and demos, product development, and addressing sales and client queries to facilitate successful sales conversations. Can we have a huge round of applause for Mr. Sandeep Seal?
All right. So, when deciding the topic for this session, a couple of things came into my mind. Mr. Balaji mentioned a word, efficiency. And that's really what it boils down to. I remember last year when I was watching with my daughter India's great achievement of landing the lunar module on the south side of the dark side of the moon. I was so inspired just with all the contributions from ISRO, all the people excited. And, it took a lot of hard work and dedication and so on. And guess what? In the Western world, people were talking about how it was the entire budget of that entire mission, 75 million or so, was actually less than that of the movie Interstellar. And I mean, not to take away from the efforts and all the effort that we managed to put in for a country like India, and I think we were the third country to do something like that. Even China hadn't done it. But the focus was on cost efficiency. Even now, if you look at the US inauguration, you've seen all these stalwarts, tech giants, Sundar, Elon, and so on. And you'll see that a lot of the people on the Democratic side, who were earlier Democrats, they're now supporting something called the Department of Government Efficiency, DOGE. And again, there the key word is efficiency. Now, most of us here are Indians. We grow up in school. Many of our friends tell us, do smart work, not hard work. We are also a culture of jugaad, and we also grew up with stories from Birbal, Chanakya, Tenali Raman, and we are inspired by the wit, wisdom, and intelligence. And so the reason I chose this topic was because imagine, we all topic is because, AML compliance, regulatory compliance is something which is ubiquitous now. All institutions, whether banks, finance companies, payment operators, PSPs. In India, we've seen RBI having regulations recent regulations affecting insurance companies, asset management companies, and capital market sector. And one of the pain points that, and we all know that the AML financial crime solution, it's essentially a cost center. You don't get any revenue from it. So really, the focus is that if you're not going to get any money out of it and you have to comply with it, there is a cost involved. And one of the biggest pain points and challenges that that compliance teams face is the amount of alerts that they get. They get a huge amount of alert flooding. And there's a lot of false positives involved here. And you can imagine the amount of cost, the amount of time it takes to review those alerts. You can imagine the amount of late nights that people, parents, we are all moms and dads, we all have families to go to. So if you're going to get 500 alerts assigned to you, and you want to make it home by 7 or 8 in the evening, how are you going to do a decent job? How are you going to do the right job in reviewing all those alerts? And so with that in mind, I decided to focus, give a very point-wise solution, the kind of solution that you might, as students, have, when you have a difficult question or homework that your teacher has given you, yeah, that's fine. You might, as students, we used to refer to guidebooks because they used to give us all the answers. So I guess what I was planning to do was to kind of summarize the learnings that we have had as an organization, that our team has had as senior AML consultants, and condense that information for you so that hopefully it can be of use in your endeavors to make your teams, your compliance teams, more operationally efficient and to do a smart job, so to speak. So from here you can see that, in fact, of the thousands of alerts a mid-sized bank might get every day, almost 90 to 95% of them are false alerts. So imagine the amount of effort that you have to go through reviewing each of those alerts, in entering comments, escalating it, doing the due diligence, enhanced due diligence for all of them. And then at the end of the day, you only get a sliver, perhaps 5% of those alerts which actually convert to SARS, STR, Suspicious Transaction Reporting, to the FIU India. And so that can be a bit of a bummer. And also it involves a lot of resources. There's a cost involved. And, there's time involved. Sometimes you can't finish it. And, to add flame to the fire, most of the regulators, they give you deadlines. They say that you have to submit it within 48 hours or you have to submit it within 24 hours. And so that adds added pressure. And not only that, many of the data are, in silos. They are not consolidated. Some of it is unstructured. Some of it is incomplete. The alerts themselves are not necessarily configured with the right thresholds. The thinking is one size fit all does not apply. You have to look at the world. You have to be in its actuality. Not everybody is the same. Not everybody does the same kinds of transactions. And you're never going to get rid of false positives. But you're going to be able to strike a balance between the false positives and the false negatives. You're going to be able to reduce it. Remember, we don't live in a perfect world. We just try to make the best of what we can. So in that vein, what I've done is I've listed out 8 points which every financial institution should keep in mind to adopt as a process to be able to reduce these false positives and hopefully, enable those compliance officers to perhaps, reach home at early enough to spend time with their families. So let's look at it. I'll explain these in the later slides, but I guess because AI ML has become a buzzword these days, it's there in all the industries, and so people right away start off by talking about AI ML. I'm not going to do that. I'm going to start from the basics, the fundamental principles. Yes, you would use AI ML to enhance, to further use the analytics to further give you more ability to reduce the false positives, to be able to do alert scoring, to be able to identify outliers, to be able to do customer segmentation, clustering, and so on. But at the very beginning, and that's what a lot of people forget, is you have to tune those alerts properly. You know, when you have RBI, you know, giving you 200 plus scenarios, and you're going to implement all of them, and you now currently have huge volumes of transactions and huge volumes of alerts, one of the things is you have to be smart about what to exempt, what transactions, what customer types to exempt. A lot of the times this isn't done. And this is at the very first step of the alert configuration module, and that's part of the tuning. Another thing is how you combine the different parameters. You might have a different threshold for high-risk customers. You might have a different threshold for low-risk customers, for different channels, for different branches, for different customer types, for different transaction types. So just like you exempt certain internal transactions, interest payments, or whatever, you want to be able to fine-tune that particular alert with the right parameters, with different thresholds, and be able to get a better outcome. And you know, it's not always going to be right, and that's where you have alert simulation playing a part. You need to be able to test those alerts, do a what-if analysis on those alerts. Because that's how we grow up. We grow up by making mistakes, fine-tuning something, trying something different, and then we get a better result out of it. So when you have created an alert scenario, you want a feature, you want a system to be able to test that with the parameters that you've set and see how many alerts do I get? Do I get too many? If so, let me change the parameters and let me test it back. And so this alert simulation module becomes very important. What else do you need to do? You need to be able to score, risk score. The risk-based frameworks are extremely important. They are, you could say, paramount. They are the heart of an effective AML monitoring system. And wouldn't it be good where someone lets you know what alerts are more critical, are more important than other alerts? Wouldn't it be great, just like, you know, we do prioritization of tasks where we say, okay, we do this task first because it's urgent, this task can come later. You know, when we were kids, you know, with our homework and stuff, our parents used to tell us, do this later. And so you have a system which looks at the transactions, looks at the various variables within the transaction, the type of customer, the type of, the amount of transaction, the extent of deviation, whether the customer is high risk, and so on. And it formulates a risk for every single alert, and it sorts them based on the score of that particular alert, and it lets you work on those important alerts first so that you're done with the big stuff at the beginning of the day. And then as the day progresses, you can work on the less important alerts which have a lower score. Another thing that you can do is you can leverage graph analytics. So a picture is worth 1,000 words. We all know that. So wouldn't it be great if you could have data represented in graphs which show you all the fund transfers between different customers? This might be one-to-many fund transfers, many-to-one fund transfers. If you have a customer which is sending money to 10 different people in 10 different high-risk countries, or if you have two corporates which have the same director, you can know all this information where the graphs are going to tell this to you during the investigation process. So network link analysis is extremely important, which will help you in this investigation process and bring down the time taken for investigation. Of course, feedback loops are important. Whenever you identify an alert, which is not that important, you want to mark it as a false positive. Why? Because you might say, well, that's manual, but it's used later as a manual feedback for future alerts. The system is going to learn the action that you've taken, it's going to use it, and it's going to understand that for this particular type of alert, for this particular type of customer, for this particular range of amount, for this particular type of transaction type, and so on, product, channel, etc., usually those alerts are marked as false positives. It's going to learn. That's where, you know, machine learning comes into play. That's where deep learning, all of these buzzwords that we hear come into play. Alerts grouping. So obviously, you want to get a holistic view of all the alerts. We all, in the banking sector, we may have different accounts. We may have alerts generated on those different accounts. And so what you want to do is you want to be able to provide a view of a customer-specific case, wherein when you select that particular customer, not an alert, alerts being shown, but rather the actual customer with a drill down of all the alerts that they have. And then you can actually get a holistic view of what the customer is actually doing. Some of those alerts may be safe. Some of those alerts may not be that risky. On the other hand, some alerts may be extremely risky. And so you can close certain alerts while at the same time escalating others. And so grouping that also gives you visibility on what historical alerts the customer has done. All right, it will be able to drill down on and give you a 360-degree view of the particular customer, their accounts, their transaction details, their sanction matches, and so on. So that helps. So in addition to that, one more thing, profiling. So this is where contextual intelligence comes in, contextual awareness. I mentioned about one-size-fits-all policy, right? We all have different jobs, different incomes, different occupations. We do different types of transactions. And so is it really fair, to have a single threshold and to get a whole bunch of alerts on that? Does it really make any sense? In some cases, you might have a reason for the customer doing those types of transactions. It might be a large business. It might be a particular, time of year during, say, Diwali or Christmas, where there is a boom in the business cycle. So seasonality is an important factor. At the same time, you have to also look at the income profile of the customer. You have to look at the historical transaction profile of the customer. And if you can build those profiles over a period of 6 months or 1 year, and you look at different dimensions of that particular customer, the occupation, the transaction type, the credits, the debits, the transfers, the channels that the customer uses, who the customer sends money to, etc., you are able to segment the customer into different profiles and apply different thresholds to different segments, and thereby you can get a more meaningful alert. So instead of just saying, okay, anything more than 10 lakhs, raise an alert, now you say, if anything more than 100% of the customer's total transaction turnover for the month, then raise the alert. Or you can say, if anything more than 100% of the customer's debit profile or debit behavior, then raise an alert. So really focus on this customer behavior, and that contextual intelligence profiling gives it meaning. So really what we are doing is we are starting from the basics. You tune the alert first, exempt certain types of transactions, define the correct thresholds and parameters, use profiling, not to have a one-size-fits-all policy, but rather different thresholds for different customer types. Use alert scoring to let you know what are the important alerts that you can work on during the beginning of the day, and work your way towards the less important alerts. Group together alerts for different accounts of a customer into a single case and work on that particular case. Mark alerts as false positives and let it reward you down the line when you have to work on those alerts. And of course, augment it with analytics. So analytics, the biggest thing or case study with respect to AML is reduction of false positives. We'll talk about that in the later slides. Outlier analysis, NLP, natural language processing, is also important for text analysis. So we'll talk a little bit about that as well. Okay, so in fact, I've spoken about this. And what we're trying to do here is I've just given you a simple screen. And in this screen, you can see when I've selected transaction type, it gives me all the transactions. Now, generally speaking, you would just say, okay, fine. I've created this alert, transactions above threshold, I'm going to apply it to all the transaction types. No, you don't do that. You don't need to apply it on certain internal transactions. You don't need to apply it on certain customer types to government entities which, which may not be within the ambit of risk, I would say. So you can exclude them. Different thresholds for different risk profiles. So again, customer risk has to be one of the variables, one of the parameters. If you have a high-risk customer, if you have a low-risk customer, the whole point of identifying the customer risk is that you can do risk profiling. You can set your alerts based on the risk profile of the particular customer. So risk needs to be a parameter there. Alert simulation. So I've created my alert right now. I use, let's say, last month's data on that particular alert scenario that I've just configured, and I've seen that I get about 100 alerts. So fine, I think that's too much. I go through those alerts, and now what I do is I go back to the alert threshold, and I see that there are too many false positives. I tweak the threshold value. I tweak the parameters. I fine-tune them, and I go back to the alert testing screen, and I test it again. And maybe instead of 100, I get 50. And what's more is that you can even have a visual benchmarking analyzer where you have graphs which tell you at different thresholds how many alerts you will get. Wouldn't that help when you're configuring the alert? And once you've identified a particular number, a threshold value, number of alerts that you're comfortable with for that particular alert scenario, you're done. You're comfortable with it. Of course, you might have to retune it, recalibrate it 6 months down the line. But for that time, you can move it from your UAT, from testing to production. Profiling. Profiling is very important. Why? Because, look, like I said, you have different dimensions. You have channels, you have cache, you have non-cache, you have base branches, non-base branches, you have customer sending, different amounts, frequencies, time slice, ATM transactions are done at different times of day. You have customers sending to different types of customers, different countries. So you have all these different dimensions. Now, what if a system could actually learn from all these different parameters and build a customer's profile over the historical data and then use it to identify what is normal and what is not? So I think that is very useful, that you have to keep in mind. And here, you see this scoring that is done. You can sort on the score. You can identify that, okay, hey, this customer, ideally speaking, when you come to do your compliance work at the beginning of the day, you get a list of alerts, and you have each customer getting a particular case ID generated for them, which has built-in alerts associated with it. And what happens is that you have a case score generated, so you automatically work on the most riskiest customer who has the highest risk in terms of the alerts generated. And then you click on it, work on those alerts, generate an STR or not, and then you move to the next alert. So that's what this is all about, that you have to have systems in place wherein you are able to group together the customers and at the same time generate alert scores for each customer. And the alert scores themselves can be based on multiple parameters. You're looking at the type of alert scenario. So imagine you have two customers, and one of them is a high-risk customer, one of them is a low-risk customer. Both have triggered the same alert scenario. But you're obviously going to give a higher score to the customer who is higher risk. Imagine you've set a threshold for 5 lakhs. One customer does a transaction of 5,50,000, and another customer does a transaction of 15 lakhs. Now, are you going to treat both of them the same? No, you're going to obviously treat the customer who has done 15 lakhs as a higher risk score than the customer who has done 5,50,000. Similarly, you can look at the extent of deviation. You're going to look at the customer risk. You're going to look at the PEP matches, politically exposed persons. Customers who are, PEPs essentially would get a higher risk score. You're going to look at the transaction behavior as well. In case a customer does very high value transactions, cash transactions, or in case a customer does, or in case an STR report has been filed to FIU India, you're going to treat that customer with a higher risk vis-a-vis other customers who may have triggered the same alert. So defining the risk parameters that would go into building this alert risk is also very important. Now, obviously, when we talk about AI/ML, there are a whole bunch of challenges that we have. I've just listed out a few of them. Data is spread across multiple silos. Data quality issues are there. You don't really understand you're not able to actually connect the dots. Do you know what I mean? With a rules-based system. And you have low operational efficiency. Again, this is where operational efficiency comes into play. A large number of false positives which eat up time, eat up resources, and so on. And so that's why we adopt AI/ML. It sits on top of your AML engine. It has both supervised and unsupervised learning. It uses R, Python, and all these technologies. It uses predictive analytics, deep learning, machine learning, and so on. Different models are used, again, depending on the particular case. There are different types of models, by the way, but then you can't select. There are no best models out there, right? You have to actually select the optimal model. You have clustering techniques, you have time and forecasting techniques, you have regression, you have random forest decision trees, et cetera, et cetera. Depending on the specific problem that you're trying to solve, you would select the appropriate model, and you'd actually test that model. And here, we have identified these areas where AI/ML can help with respect to anti-money laundering. So obviously, the first and most important focus is on reducing the false positives. But along with that, we also want to understand outliers, and that can be done through clustering, segmentation of customers based on different demographic parameters. And that will help us get what customers are acting different from their peer groups, what customers are acting different from their segment groups. This historical data will. You have trend analysis. Earlier, remember how I mentioned that you have a Diwali bonus, and immediately the system flags you. Or you have a Christmas bonus, and the system flags you. You don't want that. You want the system to understand seasonality as a factor. You also have alert risk scoring. Alert risk scoring can be manually based, but it can also be AI/ML based, which means it goes through all your historical transactions for the last 2 years, and it's able to predict certain alert risk scores. And of course, with any model, you need data, 1 year's data, 2 years' data, whatever. You first define the problem statement. What do you want to achieve with this data? Does the data have enough features? Does it have enough parameters? Is it complete data? Can I use the data? Because you're going to be doing a little bit of feature engineering associated with it. You're going to partition the data, 80/20. You're going to use some of the data to train the model and some of the data to test the model. You're going to load the data. You're going to process the data. There's a certain amount of pre-processing involved. You're going to build the model based on certain models that you select, whether it's supervised or unsupervised, depending on the particular case that you want to address, whether it's false positives or whether it's segmentation. And finally, once you've tested it, you're going to implement the model, and hopefully, you're going to get the kind of results. You're going to see a certain reduction in the types of, in the number of false positives that you get, and you're going to repeat this process for your other cases as well. And so, broadly speaking, if you look at false positive reduction, what essentially are we trying to do? So you have customers, they have a certain risk associated with it. You have these alerts, and they have a certain risk associated with it. Now, it's like you want to be able to bucket all the alerts that you get. Now, if you were to draw a matrix, some of you in maths have taken matrices in school in engineering days or whatever. And so we used to solve for eigenvectors, eigenvalues. Anyway, never mind all that. But if you look at that, you have your customer risk on the x-axis, alert risk on the y-axis. Certain customers are going to be low risk, alerts are going to be low. Certain customers are going to be high risk, alerts are going to be high. You really don't want to suppress any of the alerts which are high risk or customers which are high risk. On the other hand, you can work on those alerts which are low risk and those customers which are low risk as well. And so you focus on those bucket of alerts where the risk is either low or medium, and you apply those false positive reduction models to it. Now, the false positive reduction models essentially that we get through either, different models. You have classification, regression, etc. They learn what actions have been taken on 2 years of data, and they're going to apply that learning, that historical learning, to the new alerts. And it's going to work on those green and amber segments, and it's going to suppress those alerts. That's how you're going to do it. All right? So there's a method to the madness, essentially. You're going to be able to bucket the alerts. it gives you greater visibility on why those alerts have been marked as false positives. And with respect to trend analysis, essentially, it just identifies the anomaly using time series and forecasting techniques. It looks at the seasonality, it looks at the transaction patterns, and it's able to identify whether something is normal for the time period that the transaction has taken place in, and it's going to help you out. A couple of things I've already talked about: link analysis. So here we can see how a customer does a transaction. You're able to see if A sends money to B, B sends money to C. That's what we call layering. So you're able to see if someone is trying to obfuscate the fund flows, if two people are trying to, if two entities are owned by the same company, if two persons have the same email ID or address, all of this is going to be visible through the link analysis tool. It enables you to see static relationship links and transaction links between two entities. It's able to help you identify layering of funds. It's able to highlight those transactions for you, which have been sent to high-risk countries, and also to see all these types of AML-related risks. And here you can see the clustering segmentation, wherein you're able to see how the data, the big data, it's learning from the big data. It's able to group together the customers based on common demographic parameters, and it's able to do it based on certain models. It's able to, based on this clustering and segmentation, identify the outliers. So for example, if you have a whole bunch of, let's say in Singapore, in Vietnam, a group of rich Asian or rich Chinese businessmen who are operating, and they are doing transactions within a certain range, and there's one Chinese guy who's doing really huge amount of transactions, then that's going to show up, that green dot that you see over there. So essentially, it just enables you to profile the customers in a better way. All right, so then you have, okay, so I think I've pretty much spoken about the basics, given you some ideas. The whole purpose of this exercise was to kind of give you some gyan, where my, like I said, I was inspired by Birbal and Chanakya and all, Raman. So, and also with respect to efficiency, hopefully help all of you within the BFSI space on seeing how we can address this problem of operational efficiency, how we can handle it, and just, give a better purpose in, and more, I would say, focus and precision with respect to our jobs as compliance officers, and increase the propensity for generating accurate STRs. So I'm from Azentio. We've been in this business for the last 2 decades, and so we have quite a bit of experience in this segment. We've implemented across different countries, 40+ countries, so we understand local regulations where most of the big banks and finance companies are using our solution, and so a couple of awards also we have won. So hopefully, in case you have challenges with respect to optimizing your AML operations, feel free to reach out. Thank you very much.
Thank you. Back on this stage. And to do the honors, I would request Mr. Sanjay Sharda from Utkarsh Small Finance Bank to do the felicitation. Can we have a huge round of applause for Mr. Sandeep Seal?